Let's talk about what you guys do. You oversee the largest actively managed ETF in the world. I don't know if people know that. It's the premium income ETF. We call it Jeppy, folks, Jeppy. And it seems to have scratched a real need for investors to have some downside protection at the same time and generate income. But let's not assume everybody knows what this is. How does Jeppy work, and why has it been so successful? What do you own when you own Jeppy?
Well, I think investors for the longest time, interest rates were very low for a very long time. Investors really seeked out a high yield, and Jeppy provides that between 7 and 9%.
What do you own when you own Jeppy?
Well, you own two things with Jeppy. You own the underlying holdings, which is actively managed by a management team, active management, JP Morgan, and then you own index options written on the actual portfolio. Now, those index options are written 2% out of the money. They're rolled on a weekly basis. And when there's increased volatility in the market, when the VIX increases, that offers the opportunity for an increased amount of income to the investor of Jeppy. Conversely, when the volatility declines, given that the options are written out of the money, it provides some upside in the underlying portfolio.
Now, you say it's actively managed, but essentially it's the S&P 500, right? I mean, how much deviation is there from what you're owning?
You're getting 60% of the volatility of the S&P 500. You have two parts. The underlying portfolio is absolutely actively managed, but with an option overlay, you are selling most of your
S&P options, right?
S&P index options. You're selling most of your upside in exchange for income, but you're still offering the opportunity for some upside because they're out of the money options.
What kind of income are we generating?
It's about 9-10% right now.
Yeah. Mike, this was one of the great successes a couple of years ago, and it did strike a chord for people who wanted to still be in the market but generate income. A lot of investors are getting older; they want income. We see a lot of copycat Jeppys that are out there these days.
Yeah, this has been a huge area of the market. Kind of falls into that diverse, bifurcated market where you have folks that are really risk off with buffer ETFs and synthetic income, where you're going to have a lower upside and downside captures, and folks that are going head first into leverage inverse. But the synthetic income continues to see significant amount of inflows into this market. And one thing I just note on the Jeppy, it is a very actively managed portfolio. It has only about 40% overlap with the S&P 500 in that capacity. There are a lot of covered call strategies out there that mimic the S&P 500 in terms of their holdings, but Jeppy is actively selecting those companies in the portfolio and looks very different than the S&P 500.
Yeah, I want to just move on here. We're also seeing big inflows into ultra-short bond funds. Your main fund, JPST here, ultra-short, 4.5% yield? And tell us about this again, actively managed, short-term investment grade corporate debt. What's in this?
Yeah, it's about 55%. It has a duration of 0.75. It's a fully investment grade portfolio as commercial paper, investment grade bonds, and short duration. So,
is there treasuries at all?
There's no treasuries in the portfolio. So, if you look at the 10-year treasury has gone from 4.9 this year to 4.2%. And this fund yields 4.5% yield to worst. It provides a ballast in your portfolio, stability for those investors that are looking to protect principal. And it's really, the ultra short space has been an area in the active space that has been tremendous flows.
Love it. I mean, 4.5%, you're effectively getting what, a 2%, 1.5% real yield and take out inflation. I mean, investors, they're incredibly sticky. Our viewers love them. They love their money market funds. It's real competition for stocks, don't you think, at this point? Finally, after how many decades has bonds been no competition for stocks?
I think in the active space, fixed income is an area that's really can benefit from active management. It's a very complex market, just generally. And I think 70% of the market is actually active overall in fixed income. Putting active, using the ETF structure and using active management inside the ETF structure really is beneficial to clients, both on short term as well as intermediate as well.
Yeah, I want to move on. Mike, any thoughts on short term, ultra short bond investments?
Yeah, I mean, other than that, it's over almost 60% of all fixed income flows year to date is into short term and primarily ultra short. So this category is where people are hiding out to weather the storm in terms of where they're actively allocating and increasing allocations. Ultra short is seeing tremendous flows and is driving fixed income overall ETF flows.
Good. Let me move on and talk about equities. International equities have held up a lot better this year than people thought. When the investors looking to diversify away from U.S. stocks, essentially. So you, JP Morgan, you oversee several big ETF funds for Japan, for Canada. These are market-weighted indexes, right, of stocks in those countries. They're up in the low single digits this year. I was looking at them this morning. They're outperforming the U.S. for the first time in years, really. I'm specifically Japan and Canada here.
Yeah, we've seen flows into BBJP and BBCA. There has been an increased appetite for international investing, obviously with the environment that is currently going on right now. I do think the better way to play international right now is through active management. We have a fund called JIRE, J-I-R-E, that looks at funds, it looks at companies in different sectors, and again, bottoms up research. It doesn't veer far away from an index, but it's an actively managed approach. And if you think about international, how many international companies does the average investor know? Not many. So handing that investment process over to an active management team really makes a lot of sense. And you are seeing a huge amount of flows. And one interesting stat, there's only been 2 European ETFs that have been launched over the past 6 years. The market's really behind on European ETFs.
Yeah, but this is market weighted though. In
BBJP and BBC, yes, that's correct.
And we showed these. Look here you go. Well, here's JIRE. But if you put back Canada and other ones like Japan, it's remarkable. Look at that V shape for the last month, and you look at this, and you can't help but, as an investor, draw some conclusions about not trading around when the market panics. Don't do panic trading. I mean, I know this is an old story. We've been talking about it since Jack Bogle for 40 years, but it really bears repeating here. Don't do anything stupid when the market is crazy. I mean, what's your position on this?
Well, think about it. What we've experienced over the past few weeks, we've had 5 and 7% down days. A few days later, we had a 10% up day. So if you missed that 10% up day and you got scared and sold on the 5% down day, that really impacts your long-term returns in a portfolio. So it's not about timing the market. Again, it's about time in the market. And sometimes it's hard and sometimes it's painful. But if you have that wherewithal over the long term, you're probably going to benefit.
But isn't the point then, and I'm pulling out the stock Sherpa and you, the old wise man, is to have a plan and to stick with the plan. The studies are very clear. People tend to underperform their benchmarks because they do silly things like trying to trade themselves out of situations they're uncomfortable in. When most of us know it's better to do nothing. Jack Bogle, who's the man who had the biggest influence on me, the founder of Vanguard, used to say, don't just do something, stand there.
It's better to do nothing in a sense, but you have to kind of understand your risk profile, your risk tolerance, time horizon, how long you need to be in the market, retirement, all your goals. So I think that's really important as well. And that plays into diversification, whether it be into fixed income, into derivative income like Jeppy or JEPQ, or short-term instruments like JPST. You can build a portfolio of actively managed ETFs to cater to your risk profile and risk tolerance.